Hi everyone, welcome to Natural Rubber Market Outlook. This is episode number 27. Let us have a brief look into the performance of the rubber futures, natural rubber futures, both in the futures as well as physical markets during the previous week. So we will review the futures markets first. In the three Asian rubber futures, natural rubber prices fell during last week. In the case of Shanghai futures, the most active contracts expiring September fell by 3.7% during last week. I mean, the average during the last week was 3.7% compared to a week before. At SICO, the most active TSR20 contracts expiring October fell 1.1% last week. Means the average during last week was 1.1% lower compared to a week before. At JPS Osaka, RSS3 December contracts averaged 2.5% lower last week compared to the week before. When we look into the physical markets, STR20 Bangkok averaged 1.2% lower last week compared to the week before. SMR20 Kuala Lumpur averaged 0.1% lower. RSS3 Bangkok market averaged 3.1% lower. RSS4 Kottayam markets averaged 1.6% lower. Latex markets at Bangkok FOB averaged 1.7% lower compared to a week before. Latex markets Kuala Lumpur averaged 0.2% higher, means there is not much change, 0.2% higher during last week compared to a week before. This is a summary of the market performance during last week. In fact, the prices have been on a falling trend in all the market, both physical as well as futures, over the last 3 weeks. And last week we have seen prices continuing the downtrends without any indication of a trend reversal. So what were the factors behind the continued fall in rubber prices? These were the factors we had discussed earlier. We will briefly point out once again what were the factors which were dominating the market sentiment. So in fact, actually, the last week, that means the week ended July 23, market sentiments remained under grip of. I use the word remain because this was a situation, not anything new in the last week. This was the situation continuing over the past 3 or 4 weeks. We had a number of factors keeping sentiments down. First of all, the concerns over an imminent global economic recession. A global economic recession means demand outlook would be lower once the economy is taking a recession path. So the demand outlook was impacted by the imminent global economic recession. Another factor was the resurgence of COVID cases in China that in fact effectively puts roughly 20% or 1/5 of China's population under either a full or a partial lockdown. China is representing 42% of the global demand for natural rubber. So whatever happening in China, very crucial for the rubber demand outlook particular. Then geopolitical uncertainty largely arising from the Russian invasion of Ukraine. That was another factor keeping sentiment down. Then overheated inflation. Overheated inflation means investments on return on investment will be less attractive once the inflation rate is very high. Means the working capital is more expensive if the inflation is very high. Again, interest rate hike by central banks across countries and anticipated further rate hike by central banks across countries. So higher interest rate, again, that means return on investments will be less attractive because working capital is more expensive. Another factor is the continued appreciation of the US dollar. US dollar was continuing along an appreciating path largely due to the bet on further aggressive rate hike by the Federal Reserve in its forthcoming policy meeting of the Federal Open Market Committee, which is scheduled to be held next week. So these were the factors keeping sentiment down. These factors were not specific to rubber alone. These factors were, in fact, actually applicable to equity markets and the commodity markets, other commodities as well. In fact, all these development happening, whatever happening in the equities and other commodities were manifested in the natural rubber futures as well as physical market. This was what happened in the market during last week. But we should not ignore that there was an important positive developments in the midst of all these unfavorable factors. We had a positive development, means global shipping logistic cost sharply came down. Came down means after a substantial jump over the last 2 years, shipping cost is now coming down, especially shipping cost from Asia to Europe and Asia to US. Rates are sharply coming down. So that means shipping logistic cost is coming down. Is a positive factor, especially manufacturing cost as well as logistics cost coming down means it's a good news for the manufacturing activities and trade activities world over. So taking all this together, we can say that rubber prices have been on a declining path, and the downtrend has been driven by the factors we have mentioned earlier. And these factors were not specific to natural rubber alone, and these factors were common to entire equity markets as well as entire commodities, and the natural rubber was manifesting the development going on in other sectors world over. Now, let us see what we can expect in the week ahead. What we can expect in the week ahead, we have one side summarizing the key points. We have good news. A rebound in rubber prices can be expected this week. We are expecting a rebound in rubber prices during this week. Why? We have at least 4 factors to support such a positive outlook. Number one, global. So one major factor was keeping sentiment down was the fear of global economic recession. But according to the most recent statements by none other than US Treasury Secretary Yellen, the global economic recession fear is fading. According to US Treasury Secretary's statements, US economy need not fall into a recession. In fact, the US Treasury Secretary used another terminology. A recession is not inevitable. So recession means there should be 2 consecutive quarters of negative growth. Technically, then only we say it is a recession. We had US had in the Q1 first quarter, that means January to March quarter, US economy fell by 1.6%, means a contraction of 1.6%. And according to the latest Reuters poll, US economy will be in the positive territory in the second quarter. That means April to June quarter, it will not be negative. It will be in the positive territory. Even though the number is not so high, it will be less than 1%. So according to the Reuters poll, it will be around 0.4%, but still it is positive. Positive means we had negative growth in the first quarter, Only if the two consecutive quarters are posting negative growth, we can call it as a recession according to technical definition. So that means if the second quarter growth, which is expected to be released this week Thursday, if it is positive, that will be a big positive news. A major positive news to the entire equity market means there is no recession. It's a big news going to positively impact equity markets and commodities world over. So all the companies, corporates, and all sectors will be revising up the forecast for this year. A major news we can expect. So supporting such a view, the US jobs creation data, which was released last Friday, that remains robust in June. In June, US created 372,000 additional jobs during June. So not only this June figure, this is a fourth straight month of jobs gain in excess of 350,000 in the US. So it means the US jobs market is continually expanding in a significant way. Every month, more than 350,000 additional jobs creation, and this is continuing. So what we have seen in June is the fourth consecutive month. So it's a positive news to the market. So this job data is supporting the view that the second quarter GDP would be in the positive territory. It will not be negative. If it is not negative, there is no recession at all. It's a major news. So let us wait until Thursday how the second quarter, will it be negative or positive. We are not bothered about the number. We are not bothered about whether it is positive or negative. If it is positive, it will be a major news. So Thursday will be a very important day for the world rubber market, as well as commodity market, as well as equity market. Thursday data will be very crucial. Second factor, Ukraine and Russia last Friday, they signed landmark deals before the UN Secretary General for safe transportation of grains and foodstuffs from Ukraine ports. So the deal separately signed by the two countries at Istanbul can significantly relieve the global food crisis and help in cooling the overheated global inflation. So at the moment, one major factor which are impacting or which are causing concern to all the economies was the soaring food prices, and there was a food crisis was anticipated in the coming year. So due to the signing of the deal by the two countries, even though it was not signed together, it was separately signed by the two countries before the UN Secretary General. That means the wheat prices and also prices of other food grains will cool down, and that can significantly contribute to the global inflation. So one major factor hindering or impacting on the global economy was the soaring or overheated inflation. So if food inflation is cooling down, that can ease the global inflation fear. This is another major news. So third news is as I mentioned before, this is the coming down. Third news is the falling ocean freight costs that also significantly contribute to manufacturing costs or the production costs, manufacturing costs, as well as the that also contribute to the trade. So that means another factor which can have a positive impact on the global economic recovery. Then we have another fourth factor which is specific to rubber market. So in Indonesia is the second largest producer of natural rubber, contributing nearly 27% of the global supply. In Indonesia, due to two reasons, supply from Indonesia will be considerably lower. One, in Indonesia, around 70% of the supply is coming from the south of the equator. So for the south, that particular region, it is a leaf shedding or the wintering off season of rubber supply, one important reason. So another reason is actually in Indonesia, even for the 30% of the Indonesia's area is in the north of the equator. That north of the equator regions in the north of the equator, rubber production, it is not the off season, it is a production season. But production will be low in that region also, because Indonesia actually, there are several issues affecting the average yield of rubber trees. One major issue was the leaf disease, which has already infected nearly 0.4 million hectares of rubber trees in the country. So that is because of that yield is low. Then in the last 3 or 4 year period, the maintenance of holding was not proper. So farmers could not do proper maintenance of trees because they were resource poor, prices were not attractive. So farmers were unable to take care of the trees. That is the second factor. And also Indonesia, the age structure of rubber trees is not favorable, because Indonesia has a large proportion of senile trees. Senile means low yielding and also aged trees. So because of these factors, many of the factories processing TSR processing factories are finding it difficult to source the raw material or capillum. So this is because of this reason. Because of the low supply of capillum, the TSR processing factories are compelled to offer higher price to source the capillum. So after sourcing the capillum at higher prices, they have to pass on this higher cost to the prices of TSR. So at the moment, Indonesia's TSR prices is very high. Indonesia is often heard as a low-cost country for sourcing TSR. As of now, that is an old story. As of now, Indonesia TSR is in price-wise, Indonesia's TSR is highest among the major NR producing countries in Asia. That means the supply from Indonesia is low, and also because of the low availability of raw materials, the TSR factories are compelled to raise the TSR prices. So we have 4 factors which are supposed to support a rebound in rubber prices during the coming this week. But at the same time, we should not expect a major gain in prices, a substantial gain in prices. We can expect a major rebound. We can expect a rebound in prices, but gains will be limited. Reason is that there is last week we have seen a further resurgence of COVID cases in China. So that continued lockdown, China is still following the zero COVID policy. That means a continued lockdown means, as I mentioned before, 1/5 of China's population is under partial or full lockdown. So this is affecting whole economic activities in the country. So this continuing lockdown is prolonging the uncertainty hanging over China's economy, and China is accounting nearly 43% of the global demand for natural rubber. So whatever happening in China is crucial for global demand for natural rubber. So this is a major limiting factor. So we have a set of factors which are helping a rebound in rubber prices. At the same time, we have to take into account that the gain in prices will be limited due to the China factor, which is often referred to as the C factor. China factor will be there, so that will be a limiting factor, but still we can expect some kind of a rebound in rubber prices. That's all for this week. Thank you very much. We will see again for episode number 28. Thank you very much. See you again next week at the same time.